So my mortgage went from $2,500 a month for my 5-bedroom house to $7,500 in 7 years. It went up to $7,500, and yeah, he's a witness. I could not afford it.
See, this is the thing, people. When you are purchasing a new construction, you have to remember that the taxes have not been assessed.
Taxes are not to blame for this, though I do think they are a contributing factor. Later in the video, we'll talk about what I think actually happened in this video. But the real reason we're here is to talk about some common factors that can make your home go from affordable to unaffordable in as little as a year or even more time if you're not careful. And I'm going to show you how to avoid that. And just because I love you, I'm also going to teach you how to reverse course and make your mortgage just a little bit cheaper over time as well. Hope you enjoy it. Let's dive in. So let's start with taxes. Now, wherever you live, your county or state is going to tax you for owning your land. And they're going to give your house a value based around whatever they think the market value for it is, and then tax you on whatever that percentage rate is. Now, for the lady in the video, they said that she bought a new construction and she only paid initial taxes for the land because that's what the builder was paying. It didn't have a house on it, so the assessed value was just for the value of the land. And then after that, once you put a $500,000 house on it, then that's what you got taxed on, and that's how the payment ran up. I don't think this is what happened to her, but I don't want it to happen to you. So if you're gonna close on a new construction house, make sure that the taxes they pull at closing to fill up the escrow account, make sure that that is based on the amount that you are having for your sales price or what you think the tax assessed value on the house might be in the future. Unless you're okay with paying the little bit now and then having to catch up on it later. But my advice is to make sure that you're getting taxed on the full value of the house, not just the value of the land. If you got a good lender and a good real estate agent, just tell them this, but they should also be making sure they're doing this on your behalf anyway. But you know, checks and balances. Now, another way that taxes can bite you in the butt is if you have appreciation over time. We all want our property value to increase, right? Like I most certainly do. But what I do not want is to have to pay higher taxes. And that's exactly what happens. If the price of your property goes up, then the assessed value per the county goes up. So that's more taxes. So it's kind of a good and bad thing. We all want that equity, but we don't want to pay those taxes. So here in Texas, we have this thing called a homestead exemption. And basically it's a protection. It makes sure that you can only get charged an increase of about 10% per year, no matter how high the value of your house goes. Also, a good way to kind of save on taxes would be to file for homestead because it gives you a small decrease in the percentage of taxes that you're charged. And another little tidbit here, for Texas, you can actually dispute the amount of those property taxes. So if you get that bill in the mail and it says your house is worth $500K, you can take it, fight it and say, hey, it's only worth $450. And you're gonna go by the past sales over the past year. Get your real estate agent to help you out with that. There's also a couple companies that do it and they do it for a pretty reasonable fee. But yeah, it's something you can do to decrease the amount of your mortgage. Even if you bought it at a certain price, Texas, non-disclosure state, they don't know what I bought it for. If you can prove that it's only worth this dollar amount, then you can lower your mortgage payment. Now let's talk about insurance, because when you talk about taxes, you got to talk about insurance, because if you have an escrow account, that essentially means you're paying both of those together every month. Now, insurance rates can go up like crazy over the years if left unchecked. What I realized is that, first of all, you have to shop insurance carriers and listen to all of the crap that they're throwing out at you, because it is a lot. But if you listen and you talk to a few different people over time, it'll start to make sense. Maybe I'll do some videos on this channel about it just so it makes a little more sense to you, but you have to shop them. Don't let them just give you a new increase on your insurance rate and think that that is the only thing that you have to accept. My previous insurance amount went up by almost $1,000 a year, and I just wasn't about to have it. And it just took for me to call around to a couple different places to get a lower rate with the same amount of coverage. So do your due diligence. And if we're talking about making things more affordable, sometimes at closing, we just accept the insurance carrier that either our realtor gave us or our mortgage company gave us, but they're not always going to be the best option. All right, now let's talk about the one that everybody loves to hate, interest rates. Now, it's been a hot topic in the news, and I feel like people know more about interest rates now than they ever have before. Interest rates should not change over the life of your loan, depending on the type of loan you get. Okay? That's the only way that it's going to become more unaffordable over time, is if you have the type of interest rate that changes over time. Now, that's called an adjustable rate mortgage, and you gotta look out for those. Those were a big thing in like the 2008 crash, and it's basically them saying like, hey, I'll give you a low interest rate today, but tomorrow that interest rate is going to go up by this amount of points based on whatever the current rate is. And then there's also like a cap. Now, when I was doing my mortgage loan officer school, this adjustable rate mortgage thing was the hardest thing for me to wrap my head around, like how it worked, the lingo, none of it made sense to me. And it took for one of my OG veterans, shout out to you, he had to really school me and like give me how this actually works. And so I can only imagine how confusing it is to somebody who is just a regular consumer about to get a loan on the house, and somebody says, yeah, you can pay $1,000 a month for the next 2 years, and then after that it'll go up, and they typically don't tell you what it will go up to. So that is actually what I think happened to the lady at the beginning of the video. I think that she had an adjustable rate mortgage, and I think she had like a deadly cocktail of things. An adjustable rate mortgage that went up over time, also insurance premiums that went up over time, and tax value that went up over time. Now, if you add all three of those with the adjustable rate mortgage really being the gasoline on the fire, then it is easy to see how you could end up with a $5,000 a month increase on your payment. Now, that's just crazy. So typically with the adjustable rates, let's stay here for a moment. The thought is that interest rates are going to drop over time. So you take this lower than market rate interest rate, and in a couple years or however long you negotiate for, the interest rate's going to go
down,
and it will be beneficial for you to then refinance and get into a fixed rate loan. But that's not a guarantee. I know this whole date the rate, marry the house thing is like what everybody wanted to say when mortgage rates went up to 7-8%. Here's my spiel. If you can't afford it at the market rate, then don't buy it with the expectation that the rate is gonna drop over time, because there's just no guarantee. It could go the other way. Like, you don't know what the economy is gonna do. No one really knows. Even if they tell you they do, trust me, they don't. So this next one is more of a mindset thing, and it is not as easily checked as these others. Like, these other ones are like facts and numbers. This one is thoughts and ambitions. So don't put yourself in a position where you are trying to keep up with the Joneses or really keep up with your neighbors. I know some of us buy our houses, we move into really, really nice neighborhoods, and then we look around and it feels like all the neighbors have more than us or better than us. And it just made me look at my house like, man, it's sitting pretty basic over here. But I had to check myself and say, hey, I can afford what I can afford. I would make my situation way more unaffordable if I got out there and tried to keep up with what they are doing. What I have is enough. And if I want to make improvements, then one, I'm not going to charge it to any credit. I'm going to make sure that I have the cash for it. And also, I'm not going to expect a dollar for dollar return. And that's another video for another time. But when you ride around and you see your neighbors who have like these beautiful cars and you feel like maybe you should buy a new car because their car is nice, like that's another thing that just makes your situation more unaffordable. So try and be happy and confident with what you have, and don't look at other people's situation. And they say comparison is the thief of joy, and that can really easily happen when you find yourself in a neighborhood that is a little bit more like wealthier than the neighborhood that you were in before. But another common way that this happens is daycares and private schools. Just because the neighbors have their kids in one particular school doesn't mean that you have to do that. And just because they're going to this daycare doesn't mean that you have to do that. Do what's right for your family, and I guarantee you're going to be more happy in the long run. Try and keep those thoughts in check and know that your current situation, it's enough. All right, so I promised you I would teach you how to drop your mortgage payment and make it a little bit more affordable over time. We already talked about disputing those taxes, all right? And we also talked about shopping around for your insurance. A couple other things you can do with regards to your actual mortgage itself. One is dropping your private mortgage insurance. Now, if you get a conventional loan and you didn't put down 20%, which most of us don't, then you're gonna get charged this really stupid thing called private mortgage insurance. And the only way to get rid of it is to have about 80% loan to value. Means you got about 20% equity from the price of your loan to the price of your house, right? And they will automatically drop it at 78%. But if you hit them when you're at 80% loan to value, meaning your loan is 80% of the value of your house, and that's even if the market goes up. So if you bought it at this price and the market now has your value 100K higher, if you could prove it, you can use that to lower your PMI and get it off. But it has to be after 2 years, so keep that in mind. It has to qualify. But that's a really good way to save yourself hundreds of dollars a month. Drop that PMI, private mortgage insurance. Now, if it sounds like I'm speaking a foreign language, then I kind of am. I'm a licensed mortgage lender and a licensed real estate broker. So we do this every day, and I have an amazing team around me. So if you're thinking about making a real estate decision and you want to make sure that it's in your best interest, drop a comment, send an email, whatever. We're more than happy to help. We would love to hear your story. Now, let's get back to the facts. Now, another one we'll see is MIP, which is like the stupid cousin to PMI. It is if you got an FHA loan and you get a mortgage insurance premium. Now, that might be with you for the life of the loan, just depending on your situation. But if you put down about 10%, anything lower, then it's gonna be with you. But if you put down 10%, then you can get that removed from your mortgage after about 11 years. And so that could be anywhere from $200 to $300 a month. And that's a pretty big savings. So keep an eye on that. If you already have a home and you did put down that 10%, then you need to go check that out, because they might not remove it. They might not remove it on your own. So make sure that you're up on that now. And the last option is to refinance your mortgage down to a lower payment. Now, this isn't the option for everybody, okay? And you only do this if it makes sense, because refinances cost. They cost money. There's origination fees, refinance fees, title fees, closing fees. So they're gonna fee you to death, and you gotta make sure that it's worth the fees. So please be careful when you're doing this. Be mindful of the situation. Look at those numbers. Reach out to me and my team. Let us look at it. We'll make sure it's good for you. But yeah, make sure that you're putting yourself in a better situation and not a worse one. And they will charge you out the rear. So just make sure that if you're gonna refinance to lower your mortgage, then one, it actually lowers your mortgage. Two, you're not doing any kind of adjustable thing, which I don't think you can do on a refinance. But make sure that it's gonna be the same amount from the day you close forward, and make sure that the fees and all that aren't killing you on the front end, making it almost a wash. All right, so that's my soapbox. It's really easy to go from affordable to unaffordable, and that's why it's best to just kind of shop below what you can actually afford. A good rule of thumb for your debt to income ratio is to keep it around the 35% range, somewhere in there. Typically, to get approved for a loan, you need to be around 40%. Sometimes they can get you even higher, just depending on the situation. But we're smart, right? We're prepared for anything. So we're gonna make sure that we keep our debt to income ratio significantly lower, and that we're mindful about lifestyle creep, which is like another thing that I'm gonna have to have a video about. But we're making sure that we're keeping things affordable on the offset. We have a solid budget. You don't need to be like a numbers whiz to know your numbers, and also that like our job situation is secure. I know things can change at any moment, but we want to make sure that we can control what we can control, right? So be mindful of your debt to income ratio. Just because you get approved for $400,000 don't mean you got to spend it. Hope you liked this one. I think you'll like the next one as well. Go and check it out, and I appreciate you for spending a little minute with me. I'll see you on the next one. Peace.